believe that. Well, the problem is when this inevitable bubble collapsed, the government, Federal Reserve, acted as if nobody could have seen this coming. It came out of left field. This is a 100-year flood, right? Having nothing to do with our bad policies. And what was their conclusion? That we need more regulation. We had too much capitalism, too much greed, without any idea of how it happened. Like, George Bush said that Wall Street got drunk. And I said, yeah, they were drunk and Main Street was drunk. But they didn't bother to try to figure out where the alcohol came from, why they got drunk, figure out that Alan Greenspan was the bartender. Instead, they gave the Fed more power, to liquor the country up and be even more cheap money. Well, you start off by saying that the crisis was complex. I think it was actually very simple. I mean, I'm not that smart. If it was complex, I couldn't have figured it out. It was because it was so simple that to me it was so obvious. And so, I can give you a quick synopsis or my explanation of why we had a financial crisis. The interesting thing is, what I'm about to say, I haven't really changed a word from my explanation back in 05 and 06 as to why we were going to have a financial crisis. And so, I would challenge people who would have an alternative version of what happened to say, well, where were you back then? I mean, if that was the case, then why weren't you able to forecast the crisis? Why does your explanation only work in hindsight? Mine worked in foresight. And the reason that we had a financial crisis, and of course it was inevitable that we would have that crisis, was because of bad monetary policy, bad fiscal policy, and bad regulatory policy. I mean, all three of them had to do with it. And the biggest culprit was the Federal Reserve. The Federal Reserve deliberately brought interest rates down to stimulate the economy. But it really didn't stimulate the economy in that we got more factories, we got more production, we got more output. What the Fed stimulated was consumption, and the vehicle was housing. Because interest rates went down to 1%, it made it very easy for Americans to borrow money to buy houses, and therefore the people selling houses could raise their prices because people bid on houses based on what the monthly payments are. And the lower the payment is, the more you can afford to buy. And so housing prices began to rise. At the same time, though, the banks allowed homeowners to extract the equity. So even if you didn't buy a new house, your house became more valuable. And unlike the stock market bubble, you really were able to borrow out all that appreciation. You didn't have to sell your house like you would sell a stock and then spend the money. You didn't have to sell anything. You could just borrow against the appreciating value of your house and spend money. And a lot of people were doing that. And people thought they were rich. Many Americans acted like they won the lottery because they owned a house. In fact, many Americans stopped working because they didn't need to work. They owned a house. And so people were spending money we didn't have. The trade deficit was going through the roof back then because we were spending all this money on foreign products. Because we didn't, you don't create any products when your house is going up. So we were buying products from China, from Japan, and in exchange we were sending the world our dollars, which the world had nothing to buy because we weren't producing anything. We were just building houses and remodeling houses. But our creditors were taking the dollars and using them to buy mortgage-backed securities, Fannie and Freddie, because they wanted higher yields than treasuries because the Fed had rates so low. So they took on a little bit more risk, although they thought there was really no risk. They thought that there'd be an implicit guarantee. And so it was a self-perpetuating spiral. The more money we extracted from our homes, the more foreign products we could buy, the more demand for mortgage-backed securities, the lower rates were. And it was just, people thought it was a virtuous circle. As it turns out, and I pointed out, it was a vicious circle. So the Fed kept interest rates down because it wanted people spending money. It wanted to create a recovery. Even though what they did do is they prevented a legitimate recovery from taking place. And instead, they gave us a housing bubble. And the reason that people were able to borrow so much money, one was because rates were low. And if you remember back in the housing bubble, the concept of a teaser rate. And what a teaser rate was a temporarily low interest rate that enabled you to buy a house that you couldn't afford. And where did that teaser rate come from? It came from the 1% Fed funds rate. But a lot of banks, normally they would see through this and say, well, look, you got a teaser rate. What happens in 2 or 3 years when the rate goes up? And you can't pay. We're not going to lend you all this money when it's obvious that you're not going to be able to make the payments. Well, Fannie and Freddie were guaranteeing those mortgages anyway. The government was guaranteeing mortgages based only on the ability of the borrower to afford the initial payment. Now, no bank in their right mind would make such a loan without the government guaranteeing it. Once the government guaranteed it, the banks didn't care whether the borrowers could pay back because the government was going to pay. So you had people taking advantage of the artificially low interest rates by the Federal Reserve, and then using the government guarantee to take those low interest rates and qualify to buy houses. And of course, as housing prices were going up, you get that mentality, that bubble mentality, that they can only go up. And the higher they go up, the more people want to buy them, yet the Fed is making it easy. In fact, I wrote back in 04 and 05 how paradoxically rising home prices were actually making buying a home cheaper. Because normally if you buy a house, you have to think about the cost of maintenance, insurance, depreciation, taxes, all that. But back in the housing bubble, if you buy a $500,000 house and you expect it to be worth $600,000 a year later, that $100,000 that you can borrow out represents income to you that will defray the cost of owning a home. And so rising home prices actually made home ownership cheap. In fact, people were being paid to own a house. So we had this big bubble. And the banks, of course, weren't really worried about default anyway, because, well, the house would just go up in value. So if you defaulted, well, we'll just sell the house. But nobody could come to the conclusion that all this demand would eventually turn around when all these, adjustable rate mortgages reset. You had a lot of people who were buying houses with no intention of living there. They were going to flip them or try to make a quick profit. You had a lot of speculators in there. But all this was enabled and actually encouraged by the Fed. I remember Alan Greenspan gave a very famous speech in which he praised adjustable rate mortgages at the lows of the interest rate cycle. He basically encouraged people to take out adjustable rate mortgages, said Americans were being sophisticated in managing their home equity, even as they were just spending it into oblivion. And of course, towards the tail end of the market, you had the subprime market, which was not created by the government, because once the housing bubble was really going and the government got it started, Wall Street came in to try to finance the mortgages that even the government wasn't guaranteeing. But the big problem there was, who was the biggest buyer of these subprime mortgages? It was Fannie and Freddie. They actually made the market. Now I'm hearing even that almost 70% of the subprime market was basically underwritten by Freddie and Fannie, but they were in there buying. And of course, without the Fed, there would have been no subprime market, because the key to a subprime loan was that teaser rate. I think the most popular one was a 2 and 28 mortgage, where you had a teaser rate for the first 2 years. And and even the mortgages that were guaranteed by the government, there was so much fraud involved in the origination. Mortgage brokers were actively working with their prospective borrowers to try to falsify their documents, their income, their wages, in order to get a Fannie and Freddie guarantee, because nobody cared. And of course, eventually they had mortgages where you didn't have to bother. You just lied. You didn't have to state your income or prove that you had a job. You just made it up. But all of this was a function of cheap money, of the moral hazard associated with guaranteed mortgages. And not only was it Fannie and Freddie, but you had the FHA that was out there actively encouraging people to buy homes they couldn't afford. You had all kinds of sham transactions where the sellers were gifting money to the buyers that they could use as a down payment to overpay for a house. And the buyers, of course, were poor people with no ability to really service the loans. The government created all this. And of course, when the lending standards collapsed as a result of all the cheap money and people were buying houses with nothing down, of course, why not gamble when, you have none of your own money on the line? And as far as, why were the regulators looking the other way? Because they were told to look the other way, because nobody wanted to rain on the parade. Everybody wanted this phony economy going, because the voters were happy. They thought they were rich, they were spending a bunch of money, the politicians were happy, the bankers were making a fortune in the short run. Everybody was making money as our whole economy was, being gutted. But this was obvious to me that it was going to end badly. I knew that eventually the music was going to stop, that real estate prices were going to fall. They would have to, as mortgage rates went up and as speculators were caught holding property that they couldn't unload. I knew that people were going to be walking away from their mortgages when they had no home equity. I knew that many people had borrowed out their home equity, several times over. and that banks were sitting on all this worthless paper that they were carrying on their books as actual assets. I knew if somebody had like a $600,000 mortgage on a house that 3 years ago was worth $300,000, I knew that the paper was going to collapse. And I knew that all the rating agencies, I could see was obvious that they were rating stuff investment grade or AAA that should have been junk. It should have been obvious, but nobody really cared because of the environment that we're in. But again, this was all what the Fed did to stimulate the economy out of the recession of 2001, 2002, which also was a consequence of bad monetary policy in the 1990s. And the big problem is that when this bubble burst, and the collapse came, and as I said, I knew this was coming. I said banks are going to fail, Fannie and Freddie are going to go bankrupt. I mean, this was obvious to me just intuitively. I didn't even have any window into the bank balance sheets. All I could, just as an observer of what was going on, I knew that these banks would fail. I knew that Fannie and Freddie would go bankrupt just based on the small amount of capital they had and the enormity of the loans that they insured. And I saw how much real estate prices had gone up. I could look at a chart, and I knew if prices would go like this, they can go like that. But nobody believed that. Well, the problem is when this inevitable bubble collapsed, the government, Federal Reserve, acted as if nobody could have seen this coming. It came out of left field. This is a 100-year flood, right? Having nothing to do with our bad policies. And what was their conclusion? That we need more regulation. We had too much capitalism, too much greed, without any idea of how it happened. Like, George Bush said that Wall Street got drunk. And I said, yeah, they were drunk and Main Street was drunk, but they didn't bother to try to figure out where the alcohol came from, why they got drunk, figure out that Alan Greenspan was the bartender. Instead, they gave the Fed more power, to liquor the country up with even more cheap money. Because I think that the crisis that's coming, that's the subject of my most recent book, The Real Crash, the crisis that's going to come as a result of this most recent round of stimulus that isn't even over, unfortunately, because now they're about to launch QE3. But this crisis is going to be worse. The bubble that we have in the government, in the bond market, in the dollar, when that bursts, and when we have a sovereign debt crisis and a currency crisis, similar to what's going on in Europe, but only on a bigger scale, when we have that, then that's the end of the game. There's no way to postpone the pain anymore. We're going to have to live through it, and unfortunately, it's going to be excruciating because of the lengths that the Fed has gone to postpone it.
And on that grim